Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500. It has now dropped 20% from the all-time high. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So we actually have quite a bit to talk about in this video. And you might be wondering, well, why are we talking about the S&P again? I mean, we just talked about it a few days ago. And normally on this channel, I don't really talk about the stock market, like the S&P that frequently. And one of the main reasons for that is because my investment strategy for stocks is actually relatively boring, right? As I've said before, I just DCA, low expense ratio index funds, as long as the risk of that index fund is below my sort of target threshold. And I don't really make it any more complicated than that. Obviously, we talk about right translated cycles and left translated cycles and, recessions and all that stuff. But like at the end of the day, what I put into these index funds is not really meant to pull out tomorrow or next year. It's something, I'm just going to keep holding on to and try to just get in as low, as cheap of a price as I can. But the reason I'm making a video right now is because the S&P 500 has now dropped about 20%. Now you might say, well, what's 20%? Why is that? Why does that matter? Well, a lot of people, when they think of recessions, they think of like the financial crisis, where the market dropped almost 60%. Or they think of the dot-com bubble, where the market dropped 50%. Oftentimes, they don't really think of other recessions like the one we had in 1989 to 1990, where the market just dropped 20%. Or the one that started, here in 1981, from the high to the low, it was a 27% drop. Or the one in 1980, where the market dropped about 21%. You see? So, yes, there's other examples where you did have 50% drops, like the dot-com crash, or 30 to 40% drops. But there are plenty of examples where it doesn't drop nearly as much. And 20% is an interesting level because there at least are, a few recessions that ended up bottoming out after a 20% drop. I mean, you can see a few right here. The recession in 1958, the recession in 1980, the recession in 1990, right? I mean, there's three examples right there. And we didn't even have to go back that far to find them. I mean, if we went back further, you'll see there's some larger drops, right? That was a 50% drop. But I mean, all in all, 20% is kind of like that baseline level where you at least start to think, all right, well, I mean, no one knows what the future holds. If it is a left translated cycle, then we're in for basically 2 years of hell, to put it lightly. But if it's not, and if it's just a 20% drop, then at least you have to start paying attention a little bit here because, well, it's already dropped 20%. Now, you could argue that 20% drops can induce recessions if they're not recovered from relatively quickly, right? So, like in this case, in the dot-com era, when it was just a slow grind down, where you had basically a 30% drop before any type of counter trend rally, by that point, the market had been trending down from September until, March. You're talking about a 6-month downtrend before really any major counter trend rally. Enough damage had been done where then a recession occurred, right? And then, we saw the market drop again, right? And in this case, from that high to that low, right, it was about a 27% drop in the recession, right? Now, yes, you could argue that we did see the market continue to go down later on. But if you think about what happened here in 2001, there was obviously a lot of geopolitical stuff going on at the time. But the recession itself was more like, the shaded region right here. It was just a 20% drop or so. Now, you might say, well, are we in a recession? And a lot of people ask this question, right? One thing you'll see people say is they'll say, well, we're already in a recession, right? We've been in a recession for a long time. Or you'll hear people say that that a recession is coming, right? But at the end of the day, no one knows. And a lot of the stuff, after it comes out, like it's irrelevant by that point. Like by the time it's announced to everyone, there's actually a really good chance the bottom for the market will be in, right? A really good chance. And I don't just say that, right? I mean, if you go look at recession statistics, if we go over to the macro side over here and we just look at past recession statistics, typically the stock market bottoms out 15 days before recessions are declared. So like if you're just sitting around waiting for something like that, normally the market actually bottoms before they're declared, not after. On average. Like there are some times where it bottoms after, right? Like in 2007, it bottomed out 3 months after it was declared. And in 1981, it took 218 days after it was declared. But I mean, in general, a lot of people aren't just sitting around twiddling their thumbs waiting for it to be declared to then sell their stocks, right? And by the time it's declared, usually a lot of the drawdown in the stock market is actually over. So that's a real important point to consider. So a lot of this depends on how long we actually spend at these levels, right? If there's a sharp recovery in the short term, then you could argue that maybe a recession is sort of pushed further out, right? If we can recover from this level really, really soon. And you might say, well, Ben, that seems kind of far-fetched. And to some degree, I would agree with you. I mean, to some degree, I would say, yeah, like it does completely seem far-fetched, and I would agree with that sentiment. But we also have to go with one of the charts that gives us an example of that very thing, and it's something that we have talked about for a while now, and that's the stock market, the S&P 500, divided by the money supply, or M2. And we have followed this primarily just because it's been a fairly good analog so far. The bull market for stocks started in October of 2022 at this level right here when compared to M2, the same level that we got a low right there back in 1996. Then the stock market divided by M2 rallied up to this level right there, which is the same exact level that the S&P divided by M2 just got rejected from. And what you'll notice back then is that when the market got this 20% drop, right, at first it dropped about 21%, which is exactly what it just dropped, right, 21%. It then, if you zoom in, right, if you really zoom in here, it rallied for like 3 weeks. And then you got another slightly lower low where the market actually went down about 24% from the high, right? 24%. Now, to give you an example of we've already gone 21% down. To give you an example of what 24% would be, that would put the S&P 500 right around 4,600, 4,700. The reason why that's an interesting level is because I believe it more or less corresponds to that 200-week moving average, right? You can see the 200-week moving average right now for the S&P is around 4678. So that would be, a 24% drop, which is exactly what it ended up dropping back over there in 1998. But you'll notice that when it had that drop, right, when we had that drop, it was relatively short-lived. It wasn't a structural decline, like a slow decline. Like it wasn't just sort of stair-stepping down like it did in some of those prior left translated cycles. It was more or less a really quick drop. Now, I don't know what happened in 1998 to cause it. I do know that the Fed also they were cutting rates from 5.5% to around 4.75% at the exact same time, or around that time. So it's not completely dissimilar to what we're seeing today. But because the market didn't really hang around these levels for a while, we were able to see the market go up one final time before the dot-com recession began, right? Now, there's a couple things to consider here with that. Like, there's no guarantee that we get that leg of it. A lot of it will depend on how long the market stays down here, okay? If it just stays down here for a few more weeks and then we're right back, we're just moving right back up, and we're back near the highs in a few months, then you could argue that a recession just gets pushed further out, right? Because it's not layoffs that initially lead to the stock market going lower. It's the stock market going lower and staying lower that basically forces companies to lay people off. So if the market doesn't spend a ton of time down here, then it might make, business owners less likely to lay people off. If, on the other hand, it stays down here a lot longer, that's when you could argue that business owners would then be forced to lay people off. They'd probably look at it and be like, oh, well, they're probably not thinking like it's a left transited cycle, but they're probably just looking at their stock price and losing hope that it's going to go back up, and then therefore they decide to cut costs. And one of the ways they decide to cut costs, unfortunately, is through layoffs. Okay? Now, the optimistic view here is that because the market dropped so quickly, like it did in 1998, perhaps, even if it does get, say, to counter trend rally for 3 weeks and then go and put down one more lower low and go to that level, perhaps there's another rally later on. And I think that there's a good chance that whenever the Fed ends QT, quantitative tightening, you'll see a rally take place, especially if it happens this year. If it happens next year, I don't know. But if it happens this year, I think there's a good chance you would see a rally take place if quantitative tightening were to actually end. So one of the things I go back to is, why is the market dropping? Now, at the end of the day, there's always narrative. And obviously this time, the narrative is tariffs, right? Tariffs, tariffs, tariffs. Everywhere you look, someone's talking about tariffs. And it's hard not to, because the President of the United States is talking about tariffs basically every single day. So you could argue that a lot of the decline is just simply caused by that. So if he were to walk some of it back, or if there were a lot of negotiations making things seem a lot brighter, and if the unemployment rate is still relatively well behaved, then it's not entirely impossible for it to repeat what it did over here in 1998. It's not entirely impossible to get that next move up, right? But the reason why it's not so clear cut is because, back over here in 2000, the market dropped, right? And it still was pretty steep, but it just didn't get a big bounce until after it had dropped, 35%. So if this thing continues to just slowly go down, right? If it just continues to slowly go down, and it doesn't get any type of big counter trend rally, and then all of a sudden we see recession data recession evidence in the data, then you could argue that something like this could just as likely happen, where it maybe sweeps this low, gets a bounce, but then it just yields a lower high. And by the way, note that, and the reason I even bring this up is because this sweep of the low occurred in April, I believe, March, April of 2001. That was a post-election year, and right now we're in, we just finished up March, we're in April of a post-election year. So yes, you could argue that we're here. You could also argue that we are here. And the reason no one knows right now is because we don't know what the labor market is actually going to do over the next couple of months. If we knew for a fact what it was going to do, then maybe you could make the argument a little bit stronger. But if you look in sort of the data, right, if you look at initial claims, one of the things you'll see is that it's still relatively low, right? I mean, we're at 219,000. As I've said before, for it to truly be recessionary, I think you need to see this over 300K, right? Over 300K. It's interesting because there already is some evidence for a recession, but not necessarily in the labor market data, the hard data, right? There's some evidence. I guess one piece of evidence is just the Atlanta Fed, which is currently projecting negative 2.8% real GDP in Q1 of 2025. And, it just has continued to go lower as we get more and more updates, and it hasn't really seen a big move up. Now, there will be another update on Wednesday, April 9th, so we'll see where it comes in. It's not entirely impossible for it to get a get a drastic change. But so far, there's a projection, right, that you'll have negative GDP in the first quarter of 2025. And if you get 2 quarters in a row, then you could argue that would be equivalent to a recession. Now, a lot of you guys might say, well, didn't we have that in 2022? And you're right, we actually did have 2 negative quarters of real GDP that were the 2 quarters consecutive of negative GDP. But I think many people might be surprised to find out that one of those quarters, I believe, and correct me if I'm wrong in the comments, but one of those quarters was actually revised to be positive like a year later. So technically speaking, even those people that say we had a recession in 2022 based on 2 consecutive quarters of negative GDP, that doesn't even exist anymore, right? Because now one of them was revised and it's technically slightly positive. The reason why, I think a lot of people think a lot of this is like some big conspiracy theory, right? But the reason why that, you didn't have the National Bureau of Economic Research declare a recession back in 2022 is because if you just look at the unemployment rate, right? Forget GDP for a moment. If you look at the unemployment rate in 2022, it was really low. Like when you look at recessions, it's where the unemployment rate is going parabolic, right? And you can see that in the data. You can see these recessions where the unemployment rate is going parabolic. So I think a lot of people think it's this like major conspiracy theory that they didn't call this a recession, but in reality, if they did call this a recession, it would be the only recession where the unemployment rate is not going up, right? Because it wasn't really going up back then. Every other recession, you get a labor market, an unemployment rate that just simply goes parabolic and is not well behaved, and no one knows how high it's actually going to go before it comes back down to earth. So this is sort of the dilemma with saying that it just happened in 2022, is that, well, the unemployment rate was really low back then. One of the interesting things, though, is that there are some things that are starting to show up. But remember, you can have recessions that are just 20% drops, right? In fact, the recession in 1990. Oh, also another thing to remember, the market usually bottoms well before the unemployment rate tops, okay? So like if you look at 1990, the market bottomed here, like when the unemployment rate was just beginning to go up, but then the unemployment rate continued to go up, but the stock market didn't care. So I think a lot of people think that they can just time everything perfectly because they're looking at the data and saying, oh, well, if the unemployment rate goes up, that means the stock market has to go down. But look at what happened over here. Like the stock market was going, or the unemployment rate was going up, and so too was the stock market. Over here, the unemployment rate in 1990, right, the unemployment rate started to go up and the stock market went down. And then later, the stock market went up as the unemployment rate continued to go up. If you look at the dot-com crash, the unemployment rate topped, in like June of 2003, but the market bottomed in October of 2002. If you look at the financial crisis, right, the market bottomed in March of 2009, but the unemployment rate didn't actually top until about half a year later. So if you're just looking at the unemployment rate, like, over the next couple of years, trying to figure out where it's going to top, and that's the time to get in, you should know that there's a good chance that the unemployment rate can continue to go up for, 6 months after the market has bottomed. Okay? So I guess the pieces of evidence that you have are that you do have an Atlanta Fed projecting negative GDP. If you look at the United States Challenger job cuts, a lot of these are from the Doge layoffs, right? The Department of Government Efficiency layoffs. This is where most of this is being attributed to. But you can see that it's actually had a pretty big spike recently. It's been relatively low. Even in 2022, you were only getting like 20 to 30,000 of these announcements until November, where it went up to 70,000. In January, it went to 103. Now it's at 275,000, right? So it's actually gone up quite a bit over the last couple of months, but this hasn't yet shown up in like initial claims, and it hasn't shown up in the unemployment rate. I mean, yes, the unemployment rate's 4.2%, and it went up, but it hasn't really started to show up, right? I mean, you're not really seeing an unemployment rate where it's like 5% or 6%. It's still relatively low right now. The other thing that I've talked about a little bit is if you go to Google Trends and you look at recessions, there's 2 times where you'll see spikes in a business cycle. We don't have a lot of data. By the way, I'll go ahead and say this now, although it pains me to have to say it, because anytime I show this chart, people are like, well, why can't you show it for, what was going on back in the 90s and the 80s, Unfortunately, Google did not exist back then. I don't like that I have to say that, but if I don't say it, then people will ask. So we just have it going back to, when we have this data from Google. One of the things you'll notice is that a lot of times you'll get your first spike during the inverted yield curve, August 2019, right? We had an inverted yield curve back then. And then you get a secondary spike later on during the actual recession. If you go back to the cycle before that, the business cycle before that, right? You had a spike in 2008, 2009 when we actually had the recession, but you also had a spike in 2007 when we had an inverted yield curve. So what essentially happens, and I've described this process before, it's like when the yield curve inverts, everyone freaks out and they're like, oh no, recession. But when the yield curve inverts, it doesn't mean recession. It means, well, it does, but it doesn't mean recession now, it means recession later. So people first see the inverted yield curve, they freak out, they scream recession, and then it then ends up not being a recession. People move on, they go about their lives, they forget about it, and then it pops back up when they least expect it, right? In the secondary spike of this trend. You can see the same thing happen in 2019 and 2020, and you could argue that when the yield curve inverted back in 2022, that's when you had this spike. And now that the market is selling off, when a lot of people really didn't expect it with the new administration, now all of a sudden you're getting all these recession worries, right? Where the recession worries are starting to spike, primarily because the stock market's down 20% in a month and a half. And again, there are recessions. We saw before 3 or 4 recessions over the last 100 years where it was just a 20% drop, right? So it's not that far-fetched to think that it's playing out like that, and just no one expects it because everyone was sort of assuming that, when the new administration took office, it would just be, sunshine and roses. But as we've said before, sometimes when you get new administrations, you can actually get sell-offs in the market initially, especially during times of high inflation and high unemployment rates. When Reagan took office in 1981, one of the things you'll notice, he took office right here, and then the market sold off for a while, right? Now, ultimately, everyone was fine, right? I mean, if you just kept investing and, yes, it lasted, a couple of years, I guess, but ultimately, everyone was fine that was investing in the S&P. And at least not with leverage, right? As long as you had enough time to watch it play out. I mean, this recession was necessary to ultimately set up what eventually happened after it. So, and also, right, in 1980, there was a brief recession where the market quickly dropped, and then another explosive move back up, and then another recession, right? You could have something like that, right, where you get sort of a brief recession in 2025, and then you get a bigger recession like in 2026. That's a possibility too. But one of the things that I talked about in the last video that we did on the S&P was I said to not really expect a strong bounce until after, at the very least, we see a sweep of the prior low from April of 2024. Now, when I made that video, the S&P was still, I don't remember exactly where it was, but it was probably like 5,300, 5,400. Maybe it was lower. I don't know. Maybe it was 5,200. I don't know. But I didn't know if we were going to sweep the low for sure. I just thought it was a high possibility. And you can see that it has, in fact, swept that low. There are times, I'm not going to go through them right now because I spent a lot of time going through it in the last video I did on the S&P, but there are a lot of examples where when the S&P does get a major sell-off, it will sweep a low from a year ago, then try to recover from it in that area, get a counter trend rally that sometimes can lead to higher highs, sometimes lead to lower highs, and then if it comes back down, then it breaks through, right? That's a distinct possibility. And whether it leads to a higher high or a lower high just depends on if we get a recession or not, right? As long as there's not a recession, if there's a recovery in the markets, like if Trump stops, if somehow we get past this tariff stuff and the market's looking at the data and the inflation stuff is okay and the unemployment rate stuff is okay, then the markets will probably go back up again. The question is like whenever they do get that counter trend rally, which will probably happen, my guess is sometime this spring, whenever that counter trend rally really gets underway, does it just do it into a lower high? And the reason why this is important is because it will absolutely affect Bitcoin. I know a lot of you guys here don't care about the stock market, but if the stock market, goes down for 2 years, then that's not good news for Bitcoin, right? It's not. So it's important to pay attention to what the stock market is in fact doing, as it could give us some insight into what Bitcoin might do. Now, remember with Bitcoin, as I've said, as long as you don't really break the integrity of a 2024 high, there's always hope of a right translated cycle. But as I've mentioned, and I will continue to reiterate, right, if we do breach that and go down to this trend line, then there's a really high chance that the cycle would in fact be over. And then the next rally from that would just be a counter trend rally into a lower high. I don't know how much sense it makes, to be so super deterministic about it right now, given the fact that we are still above the 2024 high and we haven't gone down to that trend line. But I'm just trying to be upfront with people and say, look, as long as we hold above 73K, I'm not going to be deterministic about that view. But if Bitcoin goes into the low 60s and retests this trend line, while I think there would be a large counter trend rally back up, potentially to where we are right now or even higher, it would likely just be a lower high, right, if it goes down that low. And the reason I say that is because I think if it were to go that low, I think investor confidence would in fact be lost. I think a lot of investor confidence would in fact be lost. And if you think about it, what would have to happen for it to go that low, right? I mean, we've seen the stock market go down a lot already, and Bitcoin, while it has gone down, it honestly hasn't gone down as much as you probably would have expected. I mean, if someone told you a few months ago that the S&P would be trading at like 4,800, 4,900, and Bitcoin would still be above the 2024 high, that would almost seem somewhat unbelievable, because the stock market, right, is well below that, right? I mean, the stock market, like, to give you an idea of where Bitcoin is compared to the stock market, like, the stock market just went below the April 2024 low. To give you an idea of where that would put Bitcoin, if Bitcoin did the same exact thing, it'd be like Bitcoin going to like 56K, right? Like $56,000. So that's, it's just kind of showing that Bitcoin has been holding up probably better than most people would have thought it would have, given the drop in the stock market up until this point. But as I said, when a lot of people start talking about, like it being no longer correlated, Bitcoin and the stock market no longer being correlated, normally shortly after that, then Bitcoin gets a correction too. And we talked about how these wicks are likely just, rejections off the 21-week EMA, and that we'd likely go to a lower low. And then sure enough, we did, right? And it's because the stock market, right, just continues to sell off. So the way I see it with the stock market is that in the short term, you at least have a sweep of the April 2024 low, right? You have that. It's always possible that the stock market tries to form some type of support around these levels, right? Like around the 2021 high. And in fact, I believe the NASDAQ already tested it, right? The NASDAQ already went below, it already went below the 2021 high, right? So if Bitcoin were at its 2021 high, it would put it at $69,000, right? But it hasn't gone that low. It's been holding up above, $70,000 at least so far. So, when we think about recessions and how they manifest and how it, I mean, a lot of recessions can really change consumer behavior. But I think what you have to consider is the amount of time that the stock market spends at lower prices. If we're sitting here in June and the stock market is still at 5,000, then the odds of recession are much, much higher, right? Much higher. Because companies will be forced to lay people off. And it doesn't matter what your indicators say. Sometimes you go into recessions and people just can't afford, to buy risk assets because they're too busy trying to figure out how they're going to buy groceries for the week. Okay, so it's walking a fine line, right? It's walking a fine line. There's a lot of differences between this cycle and the 1970s, and I've pointed that out a lot. Some of the differences include the fact that the unemployment rate has been trending up, not down. You may say, well, the unemployment rate trending up is not good either, and you're right, but at least it's not as indicative of a secondary wave of inflation. I have been on the side that we would not have a major secondary wave of inflation. But, to be completely honest, the whole tariff stuff has me questioning that view, right? Like, I don't know how that's going to show up in the data. I mean, even Powell was talking about, like, separating out non-tariff inflation from tariff inflation. At the end of the day, it doesn't really matter. But, one's more artificial, and could theoretically go away like that if the powers that be wanted it to. It's not structural in the same way. So, for me, like, I don't really think that the inflationary cycle was looking like the 1970s as much. And the reason is because, back over here, when we got this, these secondary waves of inflation, it was actually while the unemployment rate was going down, meaning wage inflation was going up, thus supporting that secondary and tertiary wave of inflation. You can see the unemployment rate was going down, and then inflation went up. But this cycle, we have the opposite right now. We've had inflation going down and the unemployment rate going up. So I don't really like comparing it too much to the 1970s because of that. But the reason I bring it up is because technically it hasn't deviated from it yet. And also technically with these tariffs, I don't really know how that's going to show up in the data. If a lot of companies have to raise their prices just artificially by 10%, 20%, whatever, because they have to pass on the tariffs to the consumer, then maybe you do get a secondary wave of inflation. I hope not. I hope not. I don't want that. I don't think anyone wants that. But it's at least something, to consider, right? So with the S&P being down now, about 20%, it's going to turn some heads, right? It's going to get some people's attention because even if you believe we're in a recession, right? Like, even if you say, look, Atlanta Fed says recession, this indicator says recession, and Challenger job cuts says we're likely getting a recession, right? Even if you do believe we're in a recession right now, there are examples where those recessions were just 20% drops, and that was it. There's also examples, though, where you can get 20% drops or more without recessions. And one of those examples was the drop we got in 1998, before there was another move higher. Another example, which some people have talked about recently, was 1987. Now, back then, the market dropped 36%, and somehow there was not a recession. So it just goes to show you how convoluted some of the analysis can truly be. Like with a market dropping 36% and it not actually causing a recession when almost every other time in history it has. And I don't know. I mean, let's look at the unemployment rate to see like what the unemployment rate was even doing back then. Yeah, I mean, the unemployment rate was going down. And it didn't stop going down just because the market crashed. Maybe, I don't think we had an inverted yield curve back then, so maybe that had something to do with it. But yeah, it was a pretty big drop, and it ultimately found support. Even then, it found support at the 200-week moving average, right? And there's a lot of times where you get these like big drops where at least initially there'll be support at the 200-week moving average, right? When Reagan took office, the market eventually found support at the 200-week moving average. Technically, it did eventually go below it, but not by much, right? Not by much, right? If you just say look at where it first found support at the 200-week SMA, it did go 8% below that eventually, but it wasn't like that much below it, from that. Like if you just put your money in the market when the S&P hit the 200-week SMA back then, like you were still doing fine just a few years later. Now it didn't hit that until September of the post-election year. And again, right now the stock market is not even at the 200-week estimate, right? The 200-week estimate is like 4,600, 4,700 or so. What I think, right? What I think is that, and I've said this many times. I mean, I told you guys in mid-February to expect weakness in the stock market between February OPEX and March OPEX, and we had that. And then when March OPEX came, this is options expiration, I said that, look, it's probably going to extend into early to mid-April. And now it has, right? It's been a week into April. Obviously, that weakness has continued. And I think that we likely will get a counter trend rally at some point this spring. And whether it leads to a new high or not, like it did after the 1998 drop, or if it's just kind of like when Reagan took office in 1981, right? Whether it leads to a new high or not will just simply be dependent on what the labor market looks like. Is the unemployment rate going up? Is it not? One thing I'd like to mention for Bitcoin really quick is that I think it's actually tied a lot more to the labor market than people realize. Everyone's blaming tariffs right now, right? Like everyone's blaming tariffs, and I don't blame them. Like I'm blaming tariffs too to some degree. But one of the things to note is that Bitcoin started going down as the unemployment rate started to go back up. You see that? Like as the unemployment rate starting to go back up, Bitcoin has been going down. And you'll remember that back over here, right, in 2024, it was when the unemployment rate really started to move up. Right? It was really when it started to move up right here. That's where Bitcoin was falling. So, like I said, like there's always a narrative for everything, right? And yes, we can blame the tariffs. I don't think the tariffs are helping, right? Like I certainly think they're having an impact on the market, right? I'm not just naive enough to think that they have no impact on the market. Like absolutely tariffs can impact the market. But there can also be more variables than just tariffs. Like there's also, the fact that the unemployment rate is moving higher, and we've had an inverted yield curve for a long time that recently uninverted, at least the 2-year and the 10-year did. And normally that precedes recessions, right? So there's a chance as well that the market is worried about that as well, and that is what's causing this. It could be sort of like a double whammy. Maybe if you only had one or the other, it wouldn't be so bad, but it's like when you play chess, the way you get checkmate is you create not one weakness for your opponent to deal with, but two weaknesses, right? If you create two weaknesses, the opponent can't defend both. They don't have enough resources to defend both. So what happens? Checkmate, right? That's what can happen to the markets at certain times. You have one weakness over here that's tariffs, and maybe if that's all we had to worry about, it wouldn't have been such a bad reaction. But on the other hand, you also have the labor market not looking so great, right? Oh, and by the way, you have the reverse repo that had $2 trillion in it back in 2023. Oh, $2.5 trillion has now been depleted to $148 billion, right? So a lot of this liquidity has been injected into the markets already. It's just not there anymore. So it's almost been like the perfect storm to get this drop. And, when I've looked a lot at the S&P divided by M2, and I spent a lot of time thinking about it, like, is it going to get the same type of drop? And it looks like it has for the most part. What's really interesting is this low right here, if you zoom in to the S&P divided by M2, that low corresponds exactly to the first low the S&P got in August 1998, right? And then after it got that low, it then had, a counter trend rally that lasted for about 1 month, and then there was a lower low, okay? Now, I don't know if it's going to play out the same way, But that happened 5 weeks later after the initial low. And just to give you an idea of if it were to play out in the same way, what would 5 weeks be from this low right here, right? 5 weeks would actually be May 12th. May 12th. By the way, there's going to be another Fed meeting in May. Maybe that's when they end quantitative tightening. I don't know. But you know what I do know is if you look at Bitcoin dominance plus USDT dominance, you're probably wondering what the hell this is talking about. But when you look at Bitcoin dominance plus USDT dominance, last cycle, it was actually when this metric, when this metric last cycle hit the level that it just hit, right? In July, August of 2019, the Fed ended quantitative tightening within 1 to 2 months. So there's a chance that the Fed just ends QT at one of the next couple of meetings, right? May or June, potentially. Especially if you see Bitcoin dominance plus USDT dominance up here at 75%. It already went to 70. And, it just keeps on going higher. So something to certainly keep in mind. Okay? So we've talked a lot, we've talked about a lot of stuff here. My general thought process right now is that we've had a 20% drop, right? The stock market has swept a low from a year ago. There's obviously been a knee-jerk reaction at this point. The market's hoping for something, right? If there is a rally for a few weeks, you could still come back down and sweep this low like it did in 1998. The important thing to watch going into August, September will be, does the labor market hold up or not, right? If the data supports a recession, then you likely just get a lower high. If the labor market is still doing fine, then it's still possible that you see a repeat and you just get another big rally up after quantitative tightening is over, especially if we can move beyond all this tariff drama. So those are my views right now. The reason it makes sense to talk about the S&P 500 so much is because it really does affect assets like Bitcoin. If you might not care about the S&P, but if we go through the hell that was the 1970s, there's no way that Bitcoin is not, goes through that unscathed, right? Like if we're just putting in slightly higher highs and slightly lower lows for a decade, no one wants that, right? I don't want that. You probably don't want that. Let's hope that doesn't happen. The good news is that this drop, at least so far, looks a lot different than 1970. This is like it's like an engineered crash, basically. But anyways, those are my views, guys. I just wanted to talk a little bit about the S&P, talk about it being down 20%. The main milestones to look for, I don't know how bad it'll get, but 20% is sort of like the optimistic view, even if you're in a recession, right? If someone just told you right now, hey, we're in a recession, there's still a chance that, there's recessions before where they only drop 20%. They can extend further, right? Obviously you get occasional 50% drops, but I also think there's some recency bias with that. Just because obviously the pandemic was a lot worse, but if you just look at, the last two full business cycles, they were 50% drops, but not all of them are, right? That was a 20% drop. This was like a 27% drop in 1981. In 1980, it was like a 20% drop, maybe like a 22% drop. So you can get drops that are just like 20, 27%, even in recessions. So you don't always have to have something crazy like that. I'm not saying it can't happen, but in order for something like that to happen, you need to spend a lot more time down here. You basically have to have an administration that is persistent and will not, back down on any of this stuff. And if they don't, then it's possible that it just induces a larger drawdown, which no one really wants, But we have to talk about these things in the market. For years, I feel like people have given me a hard time for talking about certain topics like ETH going home and the devaluation of ETH against Bitcoin and the devaluation of alts against Bitcoin, which, by the way, I mean, I still think is ongoing, right? I mean, all Bitcoin pairs are still well off the range lows. I'm still of the opinion that they're going to go down there. And it's been one of these things where a lot of people say they don't like it. Why am I have to be so, negative about this stuff? But not talking about it doesn't mean it's not going to happen, right? Like the process is likely going to play out regardless of whether you or I want it to. Just like ETH going home, in my mind, was always going to play out, right? Like, it didn't matter if people thought it was a crazy idea. It didn't matter that it took a long time for it to happen. The reality is that it has happened, and I think it was always going to happen. Yes, we can find a narrative to explain why, but it was a process, in my opinion, that was always going to play out because it always has. And once again, ETH has gone home. So, yes, there are times when I talk about ideas that are not what people want to hear, right? But markets do crazy things, and you have to be prepared for all these different outcomes. My sort of base case right now is that we'll likely see some form of a counter trend rally this spring, and whether it leads to a higher high or a lower high for the stock market depends on the labor market data. Whether it leads to a higher high for Bitcoin or a lower high, just in my opinion, I could be wrong, but I'm just telling you the way I'm thinking about it somewhat deterministically, is whether Bitcoin holds above that level or if it goes down here. If it holds up here, like it did in 2017, right, when it tested the 2016 high, even slightly wicked below it, right? But as long as it holds above that, then cycle's still theoretically intact. If you go below that and you come down here, I wouldn't want to be the bearer of bad news, but you probably get a counter trend rally off of it, but it would likely resolve to a macro lower high in sometime like in the August, probably like the August-September timeframe, and then it would roll over in Q4 if it were to play out like that, which no one really wants to see. So that's how I'm operating with regards to Bitcoin in terms of whether it's left translated or right translated. I think it makes sense to be sort of hedged, right? You don't want to have all your eggs in one basket, because then you're going to be freaked out on every single move that goes in the opposite direction that you want. But that's at least the way I think of the market. I've gone on long enough, guys. I'm going to wrap it up. Thank you guys for tuning in. Make sure you subscribe. Give the video a thumbs up. And again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.